Dividend growth investors, bonjour. Mike Yahoo here. Welcome to this channel where I help you invest with more conviction so you can enjoy your retirement. And speaking of, we are going to look at the two oldest dividend growers in Canada. So Fortis and Canadian Utilities, the only two companies that would qualify as being Dividend Kings as per the US definition. So showing 50 consecutive years with a dividend increase for Fortis and 52 for Canadian Utilities. A YouTube subscriber asked me, well, if I could compare both companies since they have been growing their dividend for such a long time. So today we're going to look at the business model, the investment thesis, and of course we're going to compare both companies' financial metrics to see which one looks the most interesting to this date. Full disclaimer, I do have shares of Fortis, so maybe I'm going to be biased a bit, but I'm going to try to do my best to show you the full picture. So let's get started with Canadian Utilities overview. So of course, two companies are utility businesses. We are talking about natural gas, liquid, storage capacity, pipeline, electric transmission, and some water utilities for CU. CU is mostly present in Alberta, so most of its business is coming from Canada. They have a little bit in Mexico, and they have also a little bit in Australia, and a little activities in Latin America as well. As you can see here, most of its business still comes from Alberta, where electric distribution and transmission is the biggest earner there. Second, natural gas, and then we have Luma Energy for 48 million in earnings in 2023, ATCO and Power at 46, and then ATCO Australia at 60 million. So most of the money is still in Alberta, which is kind of like a strength and weakness at the same time. Right now, Alberta economy is doing well, but it is a province that is a little bit more dependent on commodity prices than others. Still, over the past 10-20 years, it has been a good move to be there. On the other side, Fortis is virtually 100% regulated utility, so generating very stable income. It's mostly present in Canada through Fortis BC and Fortis Alberta, and also in the US. They are operating across multi-states over there and a little bit of an operation in the Caribbean. They focus mostly on electric and gas distributions, but they are now investing in renewable energies. There are some of their capex that are going there in order to diversify their portfolio and prepare the grid to receive more renewable energy in the future. So once I understand clearly what the company does, what I want to do then is to have a clear investment thesis. So pretty much all the reason why I should invest in that company, along with matching this with financial metrics. So now let's take a look at what would be the investment thesis for Canadian Utilities. As you can see here, most of the company is all about electric transmission, electric distribution, some natural gas distribution, and the company is a classic utilities where they invest a lot of capital to grow their business, invest also in renewable energy, and they expect a 3 to 4.4 base growth rate in the future. What is great about regulated utilities is they will negotiate with regulators the rate increase because they have built this relationship, they have built this bond between the regulators and the utility business, so they know how each other will react, and they make sure that they do not go for crazy rate increase that could be disapproved by the regulators. So expecting a rate increase between 3% up to 4.4 is more than reasonable, and chances are they're going to get it. Of course, we're not talking here about super powered growth companies, but this is what you want from a utility business. You want stability, you want predictable cash flow, and most of it, and most importantly, you do not want any surprises. When we look at Fortis, we do have a very similar model for growth. So in terms of the investment thesis, we're still about regulated utilities, predictable cash flow, and capex for the future. What I find interesting for Fortis though is 55% of the business capital expenditure will be financed from cash flow from operation. So as opposed to many utility business, this time we're not an all play on getting more and more debt to finance our projects, but rather having a balanced approach where 55% of the debt is financed by cash flow. The rest will be either by net debts or equity issuance. Similar to Canadian Utilities, we have renewable projects as well for Fortis. So the point here is to prepare the grid for getting more electrification, the need for, like with electric vehicle, for example, so the need for electricity will increase. So in both cases, we are planning on getting more money from those. It's going to be likely easier to increase rate as demand improves. So regulators will have no choice but to accept that there's some pressure on the grid and then therefore increase the prices. So far to make the difference between Canadian Utilities and Fortis, we are looking at two companies that are relatively similar in terms of business model. Most of their business are regulated utilities. CU is more diversified in terms of countries because they have operation in Mexico, in South America, and also in Australia, but the bulk of their business is still in Alberta. As for Fortis, they are diversified in Canada, notably in BC and Alberta, but in other provinces as well, and they have a lot of utility assets in the States, also in the Caribbean. So in terms of diversification, pretty much the same. In terms of business model, pretty much the same again. So, and two companies wants to have a little bit more renewable energy among their asset portfolio. So once again, it's pretty hard at this point to say which company you prefer versus the other. So the real test is to look at the financial metrics. So I like to have the investment thesis that is easy to understand business model, predictable cash flow, stable, dealt with regulators. So they have like this moat where they have this territory, they charge their rent and they charge their rate, and that's pretty much it. Now we're going to look at the financial metrics using the dividend stocks rock comparison tool. But before that, if you have watched this video until then, don't forget to give me a thumbs up, give me a comment, tell me which utility stocks you prefer Fortis and Canadian Utilities. And also, if you want to look at more stock ideas like this that are focused on companies with a strong dividend triangle, so companies showing revenue increases, earnings growth, and dividend growth, you can go to dividendstocksrock.com/rockstar to download the Rockstar list. And every month after that, you're going to receive the Rockstar list showing companies both on the US side and Canadian side showing revenue, earnings, and dividend growth every month in your mailbox. All right, so now let's move on to Dividend Stocks Rocks and use the stock comparison tool to watch which metrics will tell us if Canadian Utilities or Fortis is the best choice for your portfolio. All right, so let's get started by picking up the stock comparison tool in the DSR Pro section. So of course you can use that if you're not a DSR Pro user. The stock comparison tool enables me to quickly find companies and look at their financial metrics altogether. So it's very interesting to think about the business model, think about the investment thesis. So it's pretty much the narrative, the story behind the stock. But what is even more important here is to make sure that the numbers, the facts, are backing up your investment thesis. So here, if we look at the overview to get started, we see that we have, of course, two related utilities, one that will fluctuate a little bit less than the other in terms of the market. For the pro rating and the dividend safety score, you can see already that we favor Fortis versus Canadian Utilities, but we're going to take a look to know why exactly this happens. Well, first reason is quite obvious. The dividend triangle is a lot stronger at Fortis than at Canadian Utilities. As you can see, the 5 years revenue growth is 6.5% versus minus 2.8% for Canadian Utilities. Then we have earnings growth at 3.7% versus 2.3%, and the dividend growth over the past 5 years, almost 6% versus 2.7%. Right off the top, if I just stop the analysis there, I could say that Fortis is a lot stronger than Canadian Utilities with those three metrics. One thing that I love to do though is to look at the trend. So we're gonna make a quick detour to the stock card. So the stock card for Fortis, we're going to look at the dividend triangle right here. We see 10 years of metrics there. So you can see that it's very stable for the dividend increases. The earnings a little bit shakier, but still on uptrend. And for the revenue is still quite stable at the same time. So here what we see is a lot of stability, great dividend increases, and some weakness in the price right there since 2003, which could lead to an interesting buying opportunity. Of course, the problem we have with utilities right now is with higher interest rates. It had two problems. The first one is now it costs a lot more to finance their budget, their budgets for capital expenditures. And the second thing is a lot of income-seeking investors decided to get rid of their utility business and other income-producing stocks and going back to bonds and GICs, which is a lot safer and still offer 4 to 5% interest rate. So that is quite generous and will bring a little bit more stability. Now let's go back here and take a look at Canadian Utilities dividend triangle. That's going to be quite interesting here to see if it's a common trend or it's going all over the place. Well, this time we see that earnings are shakier, so it goes up and it goes down all the time. We see that revenues also is quite unstable. And then for the dividend, it is increasing, but as you can see since 2020, it's not going that fast. So a slowdown in the dividend growth on top of having weaker revenue and earnings perspective are not convincing me that Canadian Utilities should be the one that I love. So now let's go back to the stock comparison tool. We looked at the stock cards for the dividend triangle. We saw the trend, not that great. Now in terms of dividend, well, we see that Fortis is offering a lower yield, but in this case, it's probably a good sign because it's telling you that the market kind of like a little bit more Fortis than Canadian Utilities. We saw that Canadian Utilities stock price has dropped even more. Once it's interesting here is to look at the payout ratio, which is at 75 here and then 89 for Canadian Utilities. But of course, the cash payout ratio, when we look at it for utilities, it's completely useless, unfortunately, because the cash payout ratio is based on free cash flow, which will include capital expenditure. So we saw that both companies are spending a lot. They are capital intensive, which makes sense. But unfortunately, they will also get into more debt to finance those projects. So it will not, the debt will not be included there. So as you can see, Fortis is bleeding cash, and then Canadian Utilities at 146 is not able to finance their project with only cash flow. We have seen that with Fortis. They're using 55% of their cash flow is going to fund capex, but they still need to issue more shares and they still need to issue more debt. Same thing with Canadian Utilities. That's a kind of like a downside when you invest into utilities in general. They are capital intensive, so they will require debt. So the cash payout ratio is not really applicable. What's kind of crazy here though is when you look at the dividend growth rate for 1, 3, and 5 years. So you can see it is very stable for Fortis. The forecast is 4 to 6% dividend growth rate through 2026, while Canadian Utilities are definitely getting weaker and weaker. So we show a 2.67 dividend growth rate over the past 5 years, but it goes down to 1% for the past 3 years and past 1 year. Not that great, even if it shows 2 more years of consecutive dividend increases. Not necessarily in love with that. For the Chowder score, which is the 5-year dividend growth rate plus the yield, well, we see that they have also, Fortis also have a stronger Chowder score. So long story short, dividend triangle metric goes to Fortis, dividend metrics goes to Fortis. Now let's take a look at valuation. Valuation, well, 27 billion market cap versus 6. So already I would be tempted to go with the largest utility play here if I'm looking for stability. In terms of PE ratio, you can see that you're going to pay more, but sometimes you pay more for quality. And we're going to see that if we look at the average 5-year. So the average 5-year for the PE ratio will tell you what's going on over the past 5 years, how the market was willing to pay the stock and how it valued it. So over the past 5 years, it used to pay 19 times its earnings, very similar to Canadian Utilities actually, but right now the forward PE ratio here is at 17 and the other one for Canadian Utilities is at 13. What's that message? Well, what I get is the market expects less growth coming from Canadian Utilities versus Fortis, which is a little bit closer to the average 5 years PE ratio. So on the other side, you could interpret that saying, wow, there's a huge value for Canadian Utilities. That's why the PE is lower great buying opportunity. In my opinion, the PE ratio has to go lower because the revenue growth is weaker, the earnings growth is weaker, the dividend growth is weaker. So all the financial metrics are weaker than Fortis. So that explains why there is a weak valuation. We're going to end up with the debt. So debt to equity, we have a similar way to finance the business. Financial debt to equity to EBITDA, a little bit more onto Fortis. The current ratio, we have a little bit more liquidity and short-term assets for Canadian Utilities to pay. And then we have the credit score, 72 versus 64, which is pretty much the same. So here we have a small difference for the debt, not enough to make me think that I should go with Canadian Utilities versus Fortis. So my verdict on this one, because we have a similar business model, we have similar reasons to buy one or the other to get in your portfolio, but we have one with a lot stronger financial metrics versus the other. So for the same narrative, we have one that matches perfectly, the other one, a little bit of concern. So my choice will still be with Fortis. So I am really curious about your choice. So let me know in the comment below. I am curious to know if you prefer Canadian Utilities or if you prefer another utility. Also tell me if you have enjoyed this type of video, if you want me to do more, and if you want to suggest two companies in the same sector, I'll be more than happy to do them in the following weeks. All right, guys, that's enough for today. And before the next video next Thursday, don't forget to stay invested.